While everyone was watching the price charts, something much bigger was happening behind the scenes. A new executive order just opened the floodgates for $35 trillion in 401k funds to pour into Bitcoin. At the same time, companies are quietly dumping billions in real estate to buy BTC, and giants like BlackRock are tokenizing assets on Ethereum. It's no wonder analysts like Alex Becker and the folks at CryptosRus are screaming that a massive altcoin season has officially begun, sparked by Ethereum's recent surge. The question is, with all this institutional money and friendly regulation, is this the final chance to position yourself before the market truly takes off, or will the biggest gains be kept for the insiders? In the latest video from Altcoin Daily, trading expert FFE Dinam from the 100x Club breaks down a simple trading technique he claims anyone can use to profit from crypto. He says people often overcomplicate trading when a straightforward method works just fine. The method FFE Dinam outlines is a classic approach to technical analysis, often just called price action trading. The idea of buying at a 50% Fibonacci retracement level combined with a confirmation signal like a market structure shift is a very established technique. It's not a secret formula, but rather a disciplined application of core trading principles. It's interesting because it moves a trader's focus from just guessing to waiting for specific logical setups. While no strategy is foolproof, this one is built on the sound logic of buying assets at a discount and waiting for the market to confirm your idea before you risk your money. The real challenge, as he hints, isn't learning the strategy, but having the patience and discipline to actually follow it without letting emotions take over. In the latest video from Crypto Rover, he explains that Bitcoin is on the edge of a major breakout. He's watching a bull flag pattern which, if confirmed, could send Bitcoin to a price target between $125,000 and $130,000. He also points to an inverse head and shoulders pattern that suggests a potential push to around $140,000. He believes the Bitcoin bull market cycle has about 2 months left, and he plans to take his profits between $130,000 and $140,000. The video also covers Ethereum, noting that while retail investors are backing off, big players like Sharplink Gaming are buying massive amounts. He mentions a long-term target of $8,000 for Ethereum, partly driven by the future approval of BlackRock Spot Ethereum staking ETF. He also says the Bitcoin dominance chart is dropping, which could signal the start of a strong altcoin season for the next couple of months. He warns that this week will be very volatile due to major news events, including CPI and PPI data releases and Fed officials speaking all week. His technical analysis presents a very optimistic case for Bitcoin and the broader crypto market. The chart patterns he identifies are certainly ones that traders are watching closely. It's interesting that he points out the low retail involvement, as that's often seen as a sign that a rally has more room to run before it gets overheated. However, the market's direction this week feels heavily dependent on the macroeconomic data he mentioned. The upcoming CPI and PPI reports could easily override any bullish technical setup if they show inflation is still a problem. For Ethereum, the narrative around institutional adoption is strong, but the final S1 approvals for the spot ETFs are still pending. While the approval seems likely, the exact timing is still a bit of a wild card that could affect short-term price action. It feels like the market is coiled spring, waiting to see if economic news will launch it up or send it tumbling. In the latest video from CryptoTips channel, they're looking at the explosion of tokenized stocks and what it means for the crypto world. Is it a huge opportunity or a kind of Trojan horse? The video points out that while the market for these assets is projected to hit nearly $19 trillion by 2033, according to Ripple and BCG, it's not the same as owning crypto. Companies like Robinhood are offering tokenized versions of stocks like Nvidia and even private companies like OpenAI, but you're just getting price exposure, not actual ownership. There are no voting rights or dividends. The main conflict discussed is philosophical. Crypto was built on decentralization and self-custody, but tokenized stocks are completely centralized and rely on intermediaries, which is everything crypto was trying to get away from. This creates counterparty risk, as shown when OpenAI publicly stated it had no relationship with Robinhood's tokens. The video suggests these new assets could pull money away from speculative altcoins, but that Bitcoin and Ethereum will likely remain strong. The advice is to be strategic, use tokenized stocks for stability but prefer platforms that integrate with DeFi and never trade financial control for simple convenience. The video does a great job of framing the fundamental conflict between tokenized assets and the original spirit of crypto. It seems the trend is accelerating far beyond just retail platforms. The real push is coming from financial giants like BlackRock and Franklin Templeton, who are heavily investing in what they call real-world asset, RWA tokenization. Their goal isn't to embrace crypto's ideals of decentralization, but to use blockchain for its efficiency and 24/7 settlement capabilities. This feels like the financial industry is adopting the technology, but ignoring the movement's core philosophy. It's shaping up to be a two-tiered system, a regulated, permissioned world of tokenized traditional assets for institutions and the original, permissionless crypto space for everyone else. The lines are indeed blurring, but it looks more like a corporate takeover of the tech than a true merger of worlds. In the latest video from Lark Davis, he argues that we're in the best year ever for crypto and that the industry is hitting escape velocity. He points to the complete turnaround at the SEC under the new Trump administration. Just last year, regulators were waging war on crypto, but now they've launched Project Crypto with the goal of making America the world's crypto capital. This means a massive overhaul of the rules. Most tokens won't be considered securities, self-custody will be protected by law, and licensing for crypto apps will be easier. It also means Americans can finally get back into airdrops and ICOs, which they've been excluded from for years. The video does a great job of capturing the sheer optimism pulsing through the crypto market right now. The regulatory shift in the US can't be overstated. It's a complete 180-degree turn that moves the industry from a hostile environment to a supportive one. This change alone is enough to fuel a new wave of investment and development, especially in America. The narrative around tokenization of real-world assets is particularly compelling. It's not just talk anymore. Major players like Franklin Templeton are already putting assets like treasury funds on public blockchains. This is the bridge between traditional finance and crypto that people have been talking about for years, and it finally seems to be under construction. However, a lot of this bullishness feels directly tied to the current political climate. While the support is welcome, it also makes the market's health somewhat dependent on political outcomes, which always carry a degree of uncertainty. The foundation seems stronger than ever, but the biggest tailwind is political, and those winds can shift. In the latest video from the Ben Cowan channel, he explains why Ethereum has finally managed to push past the $4,000 mark. He argues that this time was different because ETH first had to go home, which means it dropped to its regression band on the USD chart. This move was the necessary catalyst for the ETH/Bitcoin pair to finally bottom out, a pattern he's seen in previous cycles like 2016 and 2019. With that foundation set, ETH now has the momentum it needs. Cowan presents a really solid case based on cyclical patterns and the internal flow of money between Bitcoin, Ethereum, and altcoins. His going home thesis provides a clean explanation for why previous attempts to break $4,000 failed while this one succeeded. His take that this is strictly an Ethereum season also rings true. You can see on social media the excitement is very concentrated on ETH, while many altcoin holders feel left behind. What's interesting is that his analysis is heavily focused on historical charts, with only a brief mention of the ETFs. The upcoming launch of the spot ETH ETFs in the US is a huge market-moving event that has no historical precedent. This could either pour fuel on the fire and accelerate the path he laid out, or it could disrupt the seasonal September pullback he's expecting. It feels like the market is front-running that ETF launch, which supports his idea that capital is flowing directly into ETH instead of trickling down to riskier alts just yet. In the latest video from Coin Bureau, Nick explains how a proposed Liberation Day to boost American manufacturing through tariffs has instead created an economic mess. The trouble began on April 2nd when the Trump administration announced aggressive tariff plans with rates up to 50% based on a strange formula that punished countries with trade surpluses like Switzerland, which faced a 39% rate. After a chaotic 90-day negotiation period, a final order on July 31st locked in these high rates, causing an immediate market downturn with the S&P 500 falling 1.6%. The video does a solid job of connecting the dots between a political policy and the actual financial pain felt by businesses and regular people. What's striking is how this isn't a theoretical exercise. The tariff strategies discussed are actively being debated in the current political arena. The idea that these policies lead to reshoring jobs back to America often misses the mark, as the video points out. Instead, we're seeing a well-documented supply chain shuffle where manufacturing simply moves from China to other low-cost countries like Mexico and Vietnam to sidestep the tariffs. This doesn't fix the underlying issue, but just redraws the map of global trade, often at a higher cost. The video's point about the weaponization of the dollar is also very real. The more the U.S. uses its currency and financial system as a tool of coercion, the more incentive it gives other nations to build alternative systems, which is a slow but steady process that's clearly underway. In the latest video from CryptosRus, the host officially calls it, "We are in an altcoin season." He points out that this trend started a few weeks ago when ETF inflows for Ethereum began to outpace even Bitcoins. Ethereum has been on a tear, breaking the $4,100 level and now seems ready to challenge its old high of $4,800 from 2021. This surge is largely credited to institutional buying. It's hard to argue with the video's overall sentiment. The market does feel like it's shifting, and Ethereum's recent strength is undeniable. This isn't just random price action, it's happening right after Ethereum's major Dinkin upgrade, which was designed to make its network cheaper and more efficient. This technical improvement directly benefits the very projects mentioned, like Chainlink and various DeFi platforms, giving real substance to their recent price pumps. The idea that institutional money is now looking past Bitcoin and into Ethereum is a powerful narrative that seems to be playing out. The 50/25/25 rule isn't new, but it's a classic risk management strategy in crypto that makes sense, especially now. It balances the safer bet on Bitcoin with the higher risk, higher reward potential of an altcoin season. In the latest video from the Crypto Banter channel, Tom walks through a complete beginner's guide on how to buy your first cryptocurrency. He explains that getting started can feel intimidating, so he breaks it down into simple, manageable steps using the BitGet exchange as an example. First, he shows how to sign up, which includes an identity verification step known as KYC. Once your account is set up, the next step is adding funds. The video points out that the quick buy option, which lets you use a credit card, Apple Pay, or Google Pay, is often the cheapest and most convenient method. After you've deposited money, it will appear as a stablecoin like USDT in your spot account. Tom advises new users to stick to the spot account and avoid the more complex trading sections. From there, buying crypto is made easy with the convert feature. He demonstrates this by converting $50 into Bitcoin and another $50 into the meme coin WIF. The process is just as simple for selling your coins back into USDT. Finally, he introduces a method for earning passive income called Simple Earn. This feature lets you stake your coins to earn interest. For example, you could earn 5% on your USDT. He strongly suggests using the flexible option, which allows you to withdraw your money at any time, as opposed to fixed options that lock up your funds for a set period. This video does a great job of breaking down what can be a very confusing process for newcomers. Using one specific exchange, BitGet, for the walkthrough is a smart way to avoid overwhelming the viewer with too many options. The focus on simple tools like Convert instead of complex trading charts is exactly what a beginner needs to see. The advice to use flexible staking is also very responsible, as it introduces the concept of earning yield without the risk of having funds locked during a volatile market period. It is worth remembering that while convenient, earning yield on a centralized exchange involves trusting that platform with your assets. This is a common trade-off in crypto, convenience versus the security of holding your own keys. Overall, it's a very practical starting point that lowers the barrier to entry for anyone curious about crypto. In the latest video from Crypto Casey, she breaks down how a recent executive order from Trump has completely changed the game for Bitcoin by allowing it to be included in 401k retirement plans. This move potentially unlocks a massive pool of capital, with about $35 trillion in total U.S. retirement assets now having a legal pathway to invest in crypto. Casey explains that if just 1% of this money moves into Bitcoin, it would mean an influx of $430 billion. Some analysts even suggest that a 3% allocation from U.S. pensions could be enough to push Bitcoin's price to $1 million. The excitement around 401k funds entering the crypto market is definitely palpable. The idea of trillions of dollars in retirement money having a green light to buy Bitcoin sounds like the ultimate catalyst. However, it's worth noting that this isn't an instant floodgate. While a supportive political climate is a huge deal, the actual implementation for plan providers is a gradual process that's been slowly building for a couple of years. The video's take is super bullish, but the reality will likely be a steadily rising tide rather than a sudden tidal wave. In the latest video from the Modern Investor, he talks about the massive and continuous flow of money from companies into Bitcoin. First, he brings up a company called Volcon, which is changing its name to Emperor Digital. They just closed a $500 million private placement and plan to put over 95% of that cash directly into a Bitcoin treasury. The speaker points out that this is just another example in a long line of companies that are seriously accumulating Bitcoin, often with little fanfare. He finds it strange that so much money is being poured into one asset while the general public seems largely unaware, noting that Google searches for Bitcoin are flat. It's one thing to hear about tech companies or hedge funds allocating a portion of their cash reserves to Bitcoin, but the news about Grupo Marano feels like a different level of commitment. A real estate firm whose entire business is built on the value of physical property deciding to liquidate $1 billion worth of its core assets is a powerful statement. It's a direct vote of confidence that Bitcoin isn't just a hedge against inflation, but a superior long-term asset compared to something as traditionally stable as real estate. This move goes beyond the Michael Saylor playbook of using debt and cash. It's a fundamental shift in strategy, pitting the two asset classes directly against each other. It really makes you wonder how many other firms in traditional sectors are having similar conversations internally. In the latest video from the Alex Becker channel, he gets straight to the point with a serious message. The recent breakout of Ethereum above $4,100 is the starting gun for a massive altcoin season. He argues that this is the final opportunity to get in on certain coins before they see explosive growth. According to him, the market follows a predictable pattern where money first flows into ETH, then into large-cap alts like Solana, and finally into smaller-cap coins within hot narratives. This is where he believes life-changing gains are made. His focus on the RWA narrative is particularly timely. The idea of tokenizing real-world assets isn't just a crypto-specific dream anymore. It's getting serious attention from traditional finance giants. For instance, BlackRock, the world's largest asset manager, recently launched its first tokenized fund on the Ethereum network. This move is a huge stamp of approval for the entire RWA sector, suggesting that real institutional money is starting to flow into the space, which could certainly fuel the kind of growth Becker is talking about. Similarly, the AI narrative remains incredibly strong across both tech and crypto markets. The connection between AI and the need for decentralized verification through blockchain is a compelling story that continues to attract a lot of attention and capital. His overall thesis banks on historical patterns repeating, and right now, some powerful real-world events seem to be lining up with his predictions.